Hey, welcome back to Lunch of the Market. In 2 days, it'll be Christmas again. And if you're short out of the money option spreads, then your presents are waiting for you under the tree. This is when we option sellers wait all month for. This is when the options that we sold at the beginning of the month or before become completely worthless. And if you had to roll down and out from last month, then you've probably been waiting even longer than just this month for those things to go to zero. So while it's easy to get all giddy, let's take a lesson from last month that we need not forget. Last month, everything looked peachy keen going into OPEX, only to see the market turn around the week of options expiration and issues like BVN, Deckers, DECK, and MCP Molycorp went completely against us, having to roll those suckers down and out to this month, and in a couple days we should see the benefit of those trades, which will expire worthless. Now, we're just days away from capturing all that profit, but last month's experience shows us that if you can take off those options, those short put spreads, for only a few cents, then you probably should. So for instance, the Molycorp 46.41 put spread, we actually bought back the short side of that, the 46s that expire in 2 days, for 15 cents. We got a ton of money to put that trade on, and we gave up probably 5% of total profit to take that trade off, but the reality is, in a stock like Molycorp, MCP, the real risk is that it blows through the $2 cushion that we have right now, and we've got an issue on our hands on Friday. So the prudent thing to do is to take that trade off, exchange some of your profit so you can sleep at night. Netflix is another spread that we took off, a 210, 205 put spread that we're short for February that expires in a couple days. We paid 3 cents to take that puppy off. Really, honestly, we'll make that profit back over the course of the year. There will probably be safer options expirations than this one. The market has run so much that prudence dictates that we take some of those profits off the table so that we go into Friday with fewer positions to manage and we're more likely to be profitable. Okay, now, the other thing that we're doing today is the cashless collar. This is a trade that we've brought to you in the past, and what it basically is, say you're long a stock, you sell a call above it, and then you buy a put below it, usually for no cost. Or, if you're lucky, you can actually take in money for this. So, take in something like Intel. We actually hate the stock, but if it wasn't for the, better than 3% dividend, we probably wouldn't have a position at all. So, rather than just take it off our screen, we actually put on some protection all the way out to May for about $2. Now, if you go out to May or June or July with your no cost or your cashless callers, then what that allows you to do is have the flexibility to roll the top side of that trade, right? So in a cashless collar or just a collar in general, the top side of that you're short. So as we know with short options, as long as they don't get exercised against you, you can roll that out to the next month, you can roll it out and up to the next month, you can buy it back if the stock tanks. There's all kinds of ways out you have of the trade if you're short that top side. And you're long the underlying stock, so you really don't have to worry about being called away, which means don't sell that top strike at a price that you're not willing to sell the stock anyway. Okay? The cashless collar is a way to protect your profits and stay long. In the case of Intel, we'll continue to collect that dividend every single quarter until the stock is eventually called away from us. If the stock moves materially up, we can roll out and up. Further out on the timeline, the put is going to be good all the way until May. In the other positions we have June or July. That's a long time to have free protection. So it allows us to sleep at night. It gives us the flexibility to roll that short side of the collar that hangs out over top of the long stock that we have, and it's a great way to manage a trade, especially on a stock that pays you a dividend. So you continue to collect the dividend. You really don't have to worry about the downside of the trade anymore because you have free protection all the way out 5 or 6 months, and then you just kind of sit back and watch and see what the market gives you. The trade that we did in Intel is so we're long the stock, we sold the May 23 call, and then sold the May 22 call, and then bought the May 21 put. So we only have about, say, 70, 80 cents of downside. Our upside, we do have some additional upside in the stock, and we did this for $2, literally $2. Okay, the collar cost us 2 cents in terms of options, but remember, every options contract represents 100 shares of stock, so you have to multiply by 100. So we paid 2 cents for this protection, cost us $2 per round lot. A round lot is just a fancy way to say 100 shares of stock. So we did this on NVIDIA, ABB, Weatherford, WFT, and Chesapeake Energy, CHK. It's just the safe thing to do. We have right? The flexibility of making the decision all the way out to May, June, or July. And we're long the put for either no cost or very low cost in most cases. And in fact, in some cases, we actually got paid to put on protection. That's a great way to manage a trade. So be on the lookout for cheap spreads that you're still short. Take those suckers off the table. You know, every month isn't the month to try to get 100% out of those spreads. This month, for us, isn't that month. We might be a little scarred from last month's options expiration, but we're going to take some of those cheap short spreads off the table. We're going to put collars around our long stock positions, and we're going to look to go into March with a ton of cash. Thanks for tuning in again today. Hope that was helpful. If you have any questions, don't forget, you can always leave a comment on the YouTube channel. You can mention us on Twitter. I think that's it. Oh, or you can leave a comment at stockpicker.com when we publish this article every day. Lunch of the Market gets published by stockpicker.com. So just remember to leave out the E when you go to StockPicker, and then you can find the articles every day. Thanks for tuning in. Have a great day, and we will see you tomorrow.